Welcome to Deal Dialogue.
Hello and welcome to Deal Dialogue, a podcast discussing all things M&A, private equity, financing, and deal related. I'm Rob Hickey with RBC Mid-Market M&A, and I'm joined by our production engineer, Tarek Chami. Well, it has been a while since our last podcast, and saying a lot has happened would be an understatement. We're recording on April 30th, 2020, and these are certainly interesting times. We're currently hunkered down in quarantine and recording this remotely, so hopefully you can accept the production quality of the podcast. The deal-making industry has been turned on its head, with COVID-19 impacting buyers, sellers, valuations, financing, and due diligence. A market that was potentially headed for a record year has in some respects ground to a halt. We thought it would be helpful to talk to some professionals in the industry to get their take on the impacts of the evolving COVID-19 crisis.
Joining us today to give his take on the market is Mario Negro, a partner with the law firm Stikeman Elliott, where he is a partner in the M&A, private equity, and venture capital groups. Mario, welcome to the podcast.
Rob, thank you. Thank you so much. It's great to be here.
Mario, you're involved in all aspects of deal making. Can you give us an overview of what you've seen happen in the markets since the beginning of the COVID crisis?
Rob, happy to provide my perspective. I look at it as kind of three different buckets in terms of the impact of COVID on the marketplace. Basically, on the larger deals, I would say the larger transactions, it's basically gone sideways. No one's closing. Larger deals for me, Rob, would be kind of any transaction 50 million and above. The good news is people haven't necessarily walked away, as in they won't come back. The bad news is they've kind of said until we determine what the new normal is, it's just waiting there. Now, as this thing drags out, of course, the risk becomes the longer it takes, the more these deals will fall off the table. But for now, very few, if any, frankly, have actually died. The second bucket of deals is the deals that were, we were under that threshold, the smaller deals that we were working on. Those deals have closed, generally speaking, and look, those deals have not been heavily influenced by COVID, so they weren't restaurants, they were retail. They tended to be software, light manufacturing, stuff that some people, I guess, now call essential services type businesses, or at least suppliers to that space. Those deals have gone on, and we're still closing them, and we've closed a bunch of them. And then the third phenomena that I've seen is obviously people reacting to the crisis in terms of their business, and that has more to do with what we call crisis work, which is trying to figure out if they're going to keep the employment group continuing on, like trying to basically manage the crisis, and that has been like most people a process of first survival, working with the cash flow that you have. Second, maintenance. How are you going to continue until things get back to normal? And I think now third is how do you adjust to the new reality, which is I think the toughest part, because we're starting to see now the beginnings of some business that are just not going to survive.
You're listening to Deal Dialogue.
Mario, I've seen you on both sides of transactions with strategic and private equity clients. When it comes to your private equity clients, what have they been doing during this time period?
So the larger ones, Rob, are basically focused on the current portfolio. So no deal making, manage the status quo, preserve the businesses that they have, try to think about how they're going to survive going forward. Probably more than strategics, I've seen them be more long-term thinking and trying to pivot and already starting to plan. And I think that gives you a sense of, I think, where private equity is at. They're already starting to think the longer term. So that's one group of private equity. Second group of private equity, I call them the value buyers. And I know you and I, Rob, have worked with these type of buyers. They've been waiting for this, sadly. I mean, I don't say that as a good thing, but they've been waiting for opportunities when valuations were going to kind of soften up a bit. So we've definitely seen a bunch of value buyers come to the market now, and they're already calling saying, look, I'm looking for deals. Problem between us is between this group is they can't get across the border. So the U.S. ones, who are the ones that have the most money, are challenged because they want to buy, but they can't get across the border. And that's going to be a big issue for any deal flow to really get back to any level that we had before. If Americans can't get across the border, easily. It's going to be very hard to get to any kind of deal flow that we were used to seeing before. Finally, I would say to the smaller deals, the lower middle market, $10 million, $5 million, $15 million deals, those are actually still going, Rob. We're still seeing a lot of activity in the lower middle market, a lot of capital willing to go there, a lot of banks still, we're seeing term sheets. So the interesting part about this marketplace, though, I experienced this in 08, 09 too, was that smaller deals still get done, and they are still getting done. And I expect we will see them get done. And frankly, that has a lot to do with the fact that a business that's resilient, a smaller business that's resilient, you could see pretty quickly whether it's going to make it or not. And if it's a survivor, it has a premium on it. The other thing is those businesses, Rob, were the ones that always had in the deal structure, always had mechanics that allowed for more contingency. Earnouts, VTBs, they were part of those deals, rollovers. They were a bigger part of those deals in the past, and so it makes them easier to do in this environment.
Yeah, it kind of turns everything that I always believed, at least in the last 10 years, on its head, which was bigger deals were typically ones that got done because they were more strategic to someone, and the smaller deals were tougher. But it sounds like right now, from your experience, the exact opposite is true.
Absolutely. A lot of people are signing up LOI, and I've honestly, I've had 5 or 6 sign up in the last few weeks, LOIs for smaller deals. And I think what the dynamic is that seller, we've been waiting for deal flow to reflect the demographics. So a lot of these sellers are older sellers, and frankly, like you're a seller of a smaller company. You could see that, what growth is going to be, no matter what space you're in, you're probably feeling nervous about growth. So if you had an opportunity to sell before, you've become imminently more reasonable now, because you realize this might be my opportunity to get out. It's not going to get any better. If it does, I got to wait 5 or 10 years. So that's part one of it. And I think that's probably going to reflect a little more even on the larger deals over time, that attitude of a seller. But I think the other half of it is, it's easier in this environment where people are concerned about their capital and want to put their capital in alternative places, given the volatility that's out there. It's easier to get your head around seeing a business that's done well in the last few months, or at least has not really been affected the way others have. It's easier to get a thesis that business is one that will survive well into the future if it survived well the last few months. I mean, it just intrinsically makes sense. And I can tell you some of the sectors, Rob. It's very interesting to see these. People are buying companies, and for example, one of them was a fertilizer business where they 3 or 4 times a year you pay upfront to do fertilize your lawn. And then that's one of the deals we have under LOI. It's a space that, basically has not been affected at all by this, right? And frankly, if it would have been affected, they have clear visibility, and it allows a lot of comfort quickly for an equity investor to see this business is real. It's going to continue to be real. And it looks like it's going to survive well. By the way, the banks are also in the lower middle market, very keen to still put money to work. Obviously, they're doing more diligence. It's taking them longer to issue a term sheet, but we have not had any banks say to us, we're out of business right now, don't call us. We've actually had banks go out of their way to say, please call us.
I'm encouraged to hear that you're seeing deal flow. I mean, obviously in the early stages, but those are the deals that we'll see closing later on and show up in our statistics. You talked a little bit about those deals in terms of how the buyers are looking at them. So you've said some have been signing up LOIs. Is there anything you're seeing different in those LOIs in terms of how buyers are looking at deals in this current environment?
So the thing, what's definitely changed is any of the LOIs the last few months for deals have basically included a contingent element. I don't think I've signed an LOI in the last couple of months that hasn't. So contingent element being an earnout, a VTB, or at the minimum, a buyer who's rolling over a substantive portion of their equity. And that's the new reality, I think. Look, in the smaller deal world, that was always the reality. There was always an element of contingency that got us there. But now I think what we're going to see as we get back to deal flow in the middle market and the larger deal sizes, I think an element of contingency, I think, is going to be part of every deal. It's going to be hard to do a deal right now without an element of contingency, given the concerns about second waves, a year and a half to a vaccine. I just don't see it, Rob, that being clean deals. are going to be tougher. I don't mean that they won't do it. For example, I've closed a couple of clean deals in the technology space, but those are the visibility on those in terms of the revenue profile is very clear. They're businesses that, frankly, they're B2B type businesses that you kind of, the businesses that use them, it's for efficiency purposes, and you have a clean sight line in terms of the revenue. It ain't changing, but I would say to you right now, the new reality is we should all expect most deals to have an element of contingency to them.
And when these deals get to the stage where you're drafting the purchase agreement, and I don't know if you're there on any of these yet, are there any major changes? I mean, my experience in the last few years has been it was a seller-friendly environment and becoming more so. How is that potentially changing now? And, you know, in terms of the major aspects of a purchase agreement, what changes are we seeing or likely to see in the near future?
So I would say kind of three key changes, Rob. And obviously, for the larger deals, one of the key changes that you'll see is larger deals tend to have interim periods. They tend to have a break between sign and close, where you have these closing conditions be met. You know, obviously, material adverse change clauses were pretty normal. They had slimmed out over the years because of a very pro-seller environment. So, for example, you know, clauses that would have included an ability to get out of a transaction because of a pandemic were hard to find, because sellers were able to kind of make them very, very slim. In fact, a lot of deals, big deals that are closing today, are deals that a buyer has no choice but to close. They're kind of stuck. They're in an we have a few of those right now, where we have buyers who are essentially stuck because they don't have an out, because their material adverse change clause was too limited. So expect material adverse change clauses to be very broad, very specific, to add words like pandemic, public health emergency, you know, health crisis. You'll see all kinds of ways of framing it, but basically to capture this. I think that's going to be a reality going forward. Two, I think you see all deals going forward for the next while having a pandemic representations and warranties. And some of those may have already been caught in the normal reps before this occurred. But, you know, for example, for us in all our purchase agreements now, we have a whole slew of pandemic reps, and we're trying to figure out is what do you know about your employees, for example? How many of them are sick? How many of them are away? How many of them are refusing to come to work? Basically, these reps are trying to get at supply chain issues, employee issues, workplace issues with respect to COVID. And I think those are going to be part of the equation for the next while, as people try to get what we call real-time visibility into the impact of COVID on the supply lines. And also another one, for example, is on accounts receivables. Have you extended out your accounts receivables? And people are looking for reps to get a feel for that. So I think you're going to see those reps be a part of the equation as well, Rob. I also think, you know, as we go forward, I would not be surprised if you're going to see, from a diligence point of view, just buyers wanting more flexibility on diligence. And, you know, sometimes we saw prior to this a very seller-friendly environment where we actually cut off diligence. You might remember this, Rob. Sellers were able to say, listen, you got 30 days to do your diligence and you're cut off. You know, those days are over. We're now seeing buyers saying, I get to basically do diligence all the way up to closing. Like, there is no limitations on my diligence because of the nature of the environment, right? Because COVID is, you know, you could have dealt with this crisis at your workplace and feel good. And yet, of course, as you know, it could come back because of this asymptomatic kind of issue, come back and haunt you. So people are very adamant the diligence has got to be full diligence all the way through the process, right up to closing. And that if there's an interim period, it's, you know, a full diligence out. And that's just the reality we're in, given that no one knows the impact of COVID on workplaces to the fullest extent, at least yet. We haven't even seen what's going to happen when people go back to work and what it really means.
Sounds like there's a lot of changes that have happened in a very short period of time. What advice would you give to business owners thinking of M&A in the near future?
So like I would say, if you're a smaller business, Rob, you know, I know smaller, we can always have a debate again of what smaller means, but, you know, anything under $20, $30 million where you think your business is worth $20 or $30 million, I would say to you, if your business has held up well, your business is going to have a shiny star on it right now. There's still a lot of private capital in the marketplace. People want to do deals still. Frankly, it's pent up now. Imagine people not having opportunity to do deals for months and months, but yet they have to put money to work because of the nature of private equity firms. You should be still going out to market. You probably have a great story to sell. You should be aware that there might be an element of you having to provide for a VTB or some contingency, but your star is shining if that business is worthwhile. Look, for a business that's under a distress pressure, there's still buyers for those kind of businesses too. If the business has a specialization or a value add that can come back and it just needs to be fixed from a supply chain point of view, there are buyers for that business. And if you feel like I'm feeling helpless and it's all coming up against me, I would say to that company, no, there actually are buyers that can help you. Obviously, you're not going to get some of the valuations that you hope, but you and I know, Rob, there's sophisticated buyers that are actually buyers who buy distressed, buy less performing companies, and maybe it's an opportunity for you to partner. For the company that I think the biggest change, Rob, I believe, is the larger deal size company. The plus 50s was originally looking for a very a generous multiple on their business. It was good times 2 or 3 months ago. We were seeing things in Canada, Rob, you and I were seeing deals 10 times, 12 times, numbers we had, I don't know, Rob, I don't think we'd ever seen them in our practices, right? So do I think that we're going to have a situation where buyers are going to be as generous on their multiples for deal sizes? No. However, I do think that if your story is compelling and you're willing to obviously allow for some element of contingency, I still think we're going to see deals happen. And I think one of the big changes that will have to occur in the next few months is people say, well, the multiples are gone. I kind of disagree. I actually think that, good companies are good companies, whether they're good times or bad, but how you structure the deals is going to be the key point. And I think we'll see some creative structuring and deals will start to get done when, as we always say, it's always about expectations between buyers and sellers. When we see the new normal kind of create some equilibrium on those expectations, I actually think we're going to see a lot of deal flow. People say I'm crazy, but I think there's going to be a lot of pent up demand and people are going to be coming back to the marketplace when we get to the new norm. The problem is when is that? And that's I think the problem right now. And I also, just to leave you with, Rob, I don't believe the new normal exists until the border between Canada and the U.S. is open. We don't have enough buyers in Canada for middle market companies. We need the U.S. buyers, and I'm actually amazed how people underestimate the role that the U.S. buyers provide to our marketplace in terms of competition, equity, just greasing the wheels of commerce here on deal flow. American buyers, whether the private equity or strategic, have been key for the last 20 years. And I just think we can't get back to normal without the border open.
I can't say I disagree with you. You've given some very frank and practical explanations for what's going on. Obviously, a lot has happened. We're starting to see the light at the end of the tunnel. It's still a long ways off, but based on what I'm hearing from you, there's opportunities out there for certain types of businesses from a size perspective and an industry perspective. And I think that, this has been some valuable insight. I want to thank you for taking the time to speak with us today, Mario.
My pleasure. Thank you, Rob, for the invite, and look forward to all of us getting back to semblance of new normal, but at least some feet on the ground and getting out there again. So look forward to seeing you out there again, Rob.
That's it for this session of Deal Dialogue. Our guest was Mario Negro, our production engineer is Tarek Chami, and I'm Rob Hickey. Deal Dialogue is a production of RBC Mid-Market M&A. Until next time, stay safe and see you soon.